All right, so today is Monday, March 13th. We are going to be getting the third section of the class, which is the valuation model, building a reusable valuation model in Excel. And we're going to all do it together at this company called Parker Hannifin. So what you're going to need is in the assignments folder, the files folder. I made an announcement about this today. You're going to need to go to the Parker folder and basically download this file, valuation model Parker start.xlsx, and have that in front of you here in just a couple minutes. Okay, so this is the beginning of the Excel valuation model that's reusable. We are going to create it together in class over the next several weeks, and at the end of this, it'll take us a few weeks to build it for Parker Hannifin. It will take you 10 minutes to reuse it for a different company. Okay, so this is very important in building the reusable model. This model will be tied to Bloomberg. It's individually created, and I will not be posting any solutions to this throughout the semester. It is incumbent upon you to create the model. If you don't create a reusable model that you can use for your assignments, you will not be able to complete future assignments. So very important that you create this file. Okay? Because I found that if I just give you the file, it'll be a black box, and you'll have no idea how it works. So the only way it's going to work is for you to create it yourself, and I'm not going to make you start completely from scratch. So that's why we're going to start with this kind of partially built model and then continue from there. But basically, everything I do, you're going to do. Okay, create your own model here. So get that file, have it up in Excel, and running in just a couple minutes. While you're waiting on that, here is the sign-in sheet for today. Don't forget to sign the sign-in sheet before you leave. And as a reminder, Wednesday is your second group project presentations. Similar format to the first group project. It's 10% of your semester grade, 10 minutes per team. All the teams will present. You'll be presenting the ROIC tree and CFI for Parker and one of its peers. As you're going through this, remember it's not just the first and last year. You got to talk about some of the key points in the middle, and you got to compare and contrast Parker against its peer. It's a lot to cover in 10 minutes for both the tree and the CFI. So my recommendation, don't come in here cold, right? Have practiced. And more importantly, if you need to use note cards to help you, feel free to use those prompts. Because at the end of 10 minutes, as some of you found out last time, when that clock's done, you're done. And if you don't get to things, it can really hurt your grade, right? Also, anything that you're presenting has to be in that PowerPoint file. So make sure that you put it all in the PowerPoint file, and don't forget to put any data that you need to use that's not in that file, because it won't count. And use numbers throughout. Don't get general. Yes?
So should we not have any speaker notes?
You're welcome to have speaker notes, but I'm saying, like, make sure that what the file you submit is the file you present. Okay, but you're welcome to use speaker notes. I would encourage that. But that's for your benefit, not for mine. Okay? Any questions about Wednesday? Because Wednesday is just presentation day. So here's the other thing. Today, this reusable model that we're building, basically, you're going to build that today in class. So at the end of class today, if you're done, that is the next homework assignment that's due the Monday you get back from spring break. So if you're able to finish it in the class today, you don't have to do anything over spring break. Okay? If, however, you don't finish it today, you have between now and the Monday after spring break to finish it. Now, this class is being recorded, so you can go back and look at it, but I'm saying take advantage of the time here today, because that way when you leave class on Wednesday, you don't have to think about anything for a week and a half relative to this class, so you come back from spring break. Okay? The other thing that's going to happen on Wednesday is the Bloomberg Trading Challenge ends on Wednesday for all sections. So just taking a quick look. Around 5 o'clock when the markets close, I'm going to go to the screen by section, your section 301, and you're going to be ranked on portfolio value from best to worst. Every team must make sure they don't have more than $300,000 in cash, or you're going to be disqualified. So don't sell, don't liquidate your portfolio. Every team must make at least 10 longs, so this team is currently on track to be disqualified, okay, for not following the rules of the competition and not making enough trades, okay? And so making a bunch of trades on Wednesday that don't clear, you're going to lose your entire team's grade, And your team will not only be able to not opt out of the final, but you also will be ineligible for any extra credit for the rest of the semester, all team members. So whoever's your team captain, get your act together. You should be making 10 trades. I've been pretty explicit about that all semester. Okay? So don't go liquidating everything. And if this team wants to have a grade, they better make 3 trades today. Okay, any questions about that? Yes.
Does this end on Wednesday?
It ends on Wednesday, 5 o'clock. But you don't liquidate. So here's what's going to happen. The Monday you come back from spring break, same teams, we'll reset everything back to $1 million worth of cash, and you'll trade again.
Oh, okay. So it's like
It's almost like we're going to start over again. So if you're hopelessly in last place, team on this list here has lost 5.6%. You don't think you're going to catch up by Wednesday, which you're probably not. All hope is not lost for your second half of the semester. You start again at 0.
that's worth another 5 quid.
And that's another 5 points, exactly. So currently, the current grade distribution for this class would be 5 points disqualified and get a 0 for all team members, 4, 3, 2, 1, if it were to end right now. That would be the grade distribution. Okay, questions? Again, don't liquidate your portfolio, because if you go above 300,000 in cash, you will also be disqualified. Okay, now notice that the winning team is barely making money because the market's been really tough. And even this week, it's gotten even tougher with all the bank challenges that we're seeing with the failure of Silicon Valley Bank and others. All right. And just as a quick side note, does everybody know why Silicon Valley Bank failed? You read the headlines? What happened? It was change in regulation, but it was also change in interest rates. Interest rates killed them. Okay, so again, for just real quick, I know it's not core to our class, but it's interesting evaluation. Like the way a bank makes money is on what they call a net interest margin. Okay, they basically borrow their cost of goods sold, is like they borrow money and they lend it out at a higher rate. So the difference between those two rates is their net interest margin. So typically what banks do is they borrow short term and they lend you out long term. Okay, so that worked really well for the banks, except 2 things happened. Number one, after the financial crisis of 2009, okay, banks had too many loans. So the world adopted something called Basel III. And what Basel III was, it was a standard for minimum amounts of equity that banks should have relative to their loan books. Okay? So practically what it meant is that for every dollar of equity, banks used to make $20 worth of loans. Okay? After Basel III, for every dollar of equity, banks could only make about $10 worth of loans. So the banks hated it, okay, because they had to have more equity and not as many loans. But the regulators were like, you levered up too much, because 2 things cause banks to fail. One, you run out of equity, okay, and if you're levered up 20 to 1, doesn't take much losses to wipe out your equity, so you got to have more equity. That was one of the regulations that came into place. And then the other one is you got to have enough cash on hand to make sure that if people go ask for their cash back, you can pay it to them. It's got to be liquid. Okay, so that's what the regulators did. And so they put in Basel III, which was a global standard, and they put in Dodd-Frank. Okay, Dodd-Frank put up additional stringent requirements for banks to make sure that we didn't repeat itself. Okay, and along came Trump. And Trump said, I don't believe in global agreements, and I don't believe in following treaties that we made with other countries, so we're going to exempt our banks from these regulations. And they went back to much looser regulation, allowing the Wild West to once again take advantage of the banking industry, which a lot of banks were lobbying for, because they didn't want to have all these stringent requirements. So Trump said, sure, you don't have to have the stringent requirements, just give me money. Put it in my campaign, and I'll eliminate the regulations. So they did. And that's the problem, is that when Silicon Valley Bank went under, 2 things happened. Number one, they didn't have a lot of equity capital lying around. And number 2, they started losing money because what happened was they took their available cash that they didn't think that their clients would need, and they put it into U.S. government securities, risk-free. But the problem is they put it into U.S. government securities when the U.S. government was paying 1.5%. Recently, the government's been raising rates. Yield on the 10-year Treasury was above 4% last week. So if I buy a bond at 1.5% and the yield to maturity on that bond now needs to be 4%, the price of that bond plummets. So the book value of Silicon Valley Bank showed huge losses on their bond portfolio. So as the tech market stumbled and these tech companies concentrated Silicon Valley Bank needed cash because their venture capital firms weren't providing them with the cash, Silicon Valley Bank had to quickly raise the cash by selling their debt. at a giant loss, which also wiped out what little equity they had. So they had to do two things. One, they sold all the bonds at a loss because interest rates are now high. And two, they had to raise equity to meet the minimum standards because they didn't have much equity to begin with. When that went out to the street, that they had to go raise equity on an emergency basis, people panicked and then started withdrawing all of their cash, which they didn't have, causing them to have to liquidate more of their portfolio at losses. And that's when the feds came in and seized them, okay? But then what the Fed realized over the weekend, and this is what's called contagion, Silicon Valley Bank wasn't the only bank that did this. Almost every other bank has the exact same problem, where they borrowed the money that they put into long-term government securities rather than cash to make some interest on it. But these are now underwater on paper because with interest rates above 4%, a 1.5% bond has a big loss. So what's going on in Silicon Valley Bank is happening at lots of other banks. That was the fear. Because now, if all these banks have to go raise capital or they're in danger of being seized, everybody wants their money back. Watch It's a Wonderful Life, traditional run on the bank. And as George Bailey said in that movie, the problem is your money's not in the bank, it's in Fred's house or Wilma's house or whatever. And that's the problem. All these banks would have to liquidate their portfolios, which at a book value would lose lots of money, and they don't have the capital to do it. So that's why the Fed and the government, the FDIC, have backstopped Silicon Valley Bank to say, we're guaranteeing all deposits. It is a taxpayer bailout because it will be worse if they have to do M&T or any of the other banks, because those are going to be who's going to be next, because all these big banks have tremendous losses on their books that are unrealized losses. And if they have to liquidate their portfolios to meet cash needs, it's going to be really, really bad for the banking system. That's also why, ironically, I was reading a headline today in Bloomberg, TOP, that the market is making a bet that the Fed is going to have to lower interest rates. That's the real bailout of the bank. Because the problem is, the higher that the interest rates go, the worse it is for American banks because they have locked in so much money at low interest rates. And remember, bond prices are the inverse of yields. Okay, that's what's actually happening. Finance 101 is basically playing itself out in the real world. And that's actually why the market today is responding in a positive way, because they're betting that the Fed will have to cut rates to bail out the banks. Now, I don't know if that's going to happen, but I say this in the context of your Bloomberg Trading Challenge. This is opportunity, because the way you're going to make money on the trading challenge is volatility. Stock prices are far different than they are today. Who's going to win? Who's going to lose? Just some suggestions. Okay, but yes, sir.
So why did Silicon Valley Bank do that? That doesn't seem like it's very that seems super risky for them to kind of bet that the Fed wouldn't raise rates.
I don't understand why they made those poor choices, but they made those poor choices.
Okay.
Because the Fed was actually pretty clear to the banks, we're raising interest rates. And Silicon Valley Bank took all their cash and put it in long-term low interest rate things, and they got screwed. But they were the only bank that did that. That's the problem. Even though the Fed's been signaling to the banking system that we're going to raise rates, the banks, I don't think, appreciated how much and how fast it was going to happen, and they got caught. And that's risk management. So it's just a failure of risk management. They could have done this a different way, but the problem is this is where we are today. And there's a lot of mid-sized banks that don't have the equity cushions, that the regulators also didn't push them too hard to get out of these positions that are in these positions. So what do you do? Okay, and that was ironically the whole conversation that happened in 2010 and 11 after the last banking crisis, which is why the regulators in order to prevent this from happening again, we're going to put these much more stringent requirements on the banks, which Trump defanged in 2018. We can't learn. Anyways, back to this. I say Trump's administration. All right, back to our class. You have this model, you're ready to go. So let's talk about the reusable valuation model. It has a series of tabs which work from left to right. Okay? The first tab is a very important tab. It's called model data. Okay? In order to value a company repeatedly using the same model, we need standardized statements. Okay? Bloomberg does not provide standardized statements. A painful lesson I have learned over the years. So we had to create our own standardized income statement and standardized balance sheet because Bloomberg does not do that. because across companies, different companies will have different formats and different structures. That's great, but if you have to do a reusable model, it's not so great, okay? So what we've done in this class is we have, over time, and I've been watching some cooking shows, we've accumulated all the ingredients, all the raw materials to make the meal so that we can make the meal. This tab represents all the ingredients to create the standardized statements. Starting with row 6 and going to row 80, those are the raw materials from the income statement and balance sheet coming out of Bloomberg, 6 historical years, to create structured income statements and balance sheets. Okay? Now, so what we've done is where this is coming from in Bloomberg, and in a few weeks, part of what you're going to have to do for your own assignments is it comes from the FA tab. FA is historical statements. Okay? If you click on Parker Hannifin, IS is the historical income statements. The problem is that BBG adjusted, Bloomberg adjusted, income statement is not the same for Parker Hannifin as it is for other companies. And I need it to be identical, and it's not. So here's how we make it identical. We go over here to the Custom tab. In the Custom tab, we create a custom exportable file. Our model expects 6 years worth of data. By default, year terminal exports 10 years worth of data. So what you're going to have to do is go to Settings and change this from number of periods 10 to number of periods 6. And then hit Update. So I have 6 years of historical data. Okay? You're also, in Settings, going to see some, on the Data tab, you're going to see all these extra columns when you export, which you don't want. So on the Data tab, make sure these 4 boxes get unchecked, because all we want are 6 years of historical data. We don't want any other extraneous data being exported. We don't need it. We don't want it. So those are 2 adjustments you're going to have to make to your terminal. Okay? Then, once you've made those 2 adjustments and updated it, you will come here and you see where it says Enter Field. You will then go back to the Excel file I've given you. Now, I've already done this for the file you have today, but this is what you will have to do. In Model Data tab, these are the 6 years, columns C through H. This is the, column A is the friendly name, which can change by company. Column B is the actual database field the data is coming from, which can never change, because Wall Street relies on column B fields. And if Bloomberg were to ever change a column B field, Wall Street would freak out. So they don't. These fields have not changed in over 30 years. So revenue could change, row 6. They can call that sales, they can call it revenue, they call it whatever they want, but they can't change the fact that that's referring to sales rev turn in the database. Okay? That's the database field, the unchangeable, column B. So your task is to take column B in this order, because this model will break if revenue's not on row 6. If revenue's on row 7, the model will be screwed up and will just blow up. So it has to be, every one of these items in this exact order have to be created. So in a custom template, you'll start out with column B6, copy that cell. You're going to go back to Bloomberg, where it says Enter Field, paste, select the first one, hover over it, validate, Excel ID, sales underscore rev underscore turn. Then you're going to go back to your spreadsheet that I just gave you. You're going to go to row 7, take cost of revenue, which is this really weird named database field, copy the weird named database field in B7, come over here, enter field, paste, select cost of revenue, verify you got the right one, repeat 78 more times. That will be something you'll have to do. At the end of these 80 fields in this exact order, you will then save this template. I call mine model. Call yours whatever you want, so that you will have a template that looks like this. Take you 10 minutes to recreate this off the column B's, but you will have to do this. Not for the current assignment, But after spring break, if you ever want to reuse the model, because I'll say your next assignment's on, I'll pick a company, Nike, go get Nike's data, value Nike. It is your responsibility to get Nike's data in this format into that model and reuse the model. I'm not giving you the model and I'm not giving you the template. So you have to create both. And if you don't have both, you will not be able to do any more assignments later this semester. So you have to do this yourself. Okay? Questions? Yes.
For some reason, my copy and paste, the numbers are different.
What numbers? You shouldn't be any numbers. Are you on Parker Hannifin? And are you on 6 years?
Yeah.
And is the last year 2022?
Yeah.
So it's not 15861.6? Are you sure you copied and pasted the right cell? Because that's what I said. There's lots of cells that say revenue that look alike. If you have the wrong cell, it might be a wrong number. But that's not your assignment today. Just letting you know it's coming if you want to get started. Okay? So here's what happens next. Once you have this template, export to Excel, this template, and what's going to happen is all this data is going to be dumped into Excel. And it is this Excel file that I've dumped into that is then the first tab in the Parker Hannifin valuation model. Does that make sense to everybody? So this is now this file. Okay, that's what I just exported. Okay? But then there's two more things you're going to have to do every time. You will notice if you click on 2022 revenue in the cell you just exported from Bloomberg, that's actually not a number. It's this weird database lookup field. Okay? Because what Bloomberg does is when it exports things, it says, aha, I'm going to link back to Bloomberg, so every time you open up the Excel file, I'm going to go pull the data from Bloomberg in real time. And that's going to be a problem because when you leave this lab, you don't have a Bloomberg terminal on your laptop, which means every time you open up an Excel file in this class, it's going to die. And we don't grade broken files. Okay? So in order to get around that and to use the data that you export, you're going to have to take all that data, select the whole tab, right-click, copy it, right-click on the whole tab, paste special values, and turn the formulas into numbers. Okay? That's something you'll have to do every time. One time when you export the data. Okay? The other thing you're going to have to do every time is for whatever reason, sometimes Bloomberg sends you a 0 and sometimes it sends you a long dash. And I'm telling you that formulas in Excel choke and break on long dashes. They won't work. So long dashes will break our model. They should be zeros. Okay? Bloomberg doesn't do that, and then it'll give you a way to stop it from giving you long dashes. So, number 2, you have to copy the long dash. You have to find the long dash. You paste what you're looking for. You replace that with zeros, replace all. So I would have had for Parker Hannifin to replace 43 long dashes with 43 zeros. Find and replace is pretty good for doing that, but you also have to do that. Then I would have taken this file, select the whole file, copy it, go to our valuation model, tab 1, select this whole tab, paste special values, and basically overwrite cell for cell, row for row what I just exported. All right? So that's how you reuse the model. And so if I did this with another company with this template, as I said, very quickly, 5-10 minutes, I can take all their data, replace it with Parker's data, and it's now valuing that company. Okay? That's what we'll do for company number 2. But as I said, this morning I did all of that for you, and it's all put in here in the Parker Hannifin model. Everyone with me today? All right, so back to our model. What else is in the model? So this is the model data tab. The tab called income is the standardized historical income statement based on those 80 fields that we pulled the raw materials for. Okay, so that's 6 years of standardized income statements. The balance sheet tab, 6 years of standardized historical balance sheets based on that historical data. Okay, you would have loved this last week for your midterm exam. The TFI tab, hooked to that standardized statement, there's 6 years of historical balancing TFI. TII tab, there's 6 years of historical balancing TII, because we have a standardized income statement and a balance sheet, which means here's 6 years of standardized CFI and 6 years on the EP tab of economic profit. So the historical economic statements are auto-generated for you and in economic format based on the standardized statements. Okay? And the final tab, called ROIC drivers, there's the auto-generated tree. Those are the trees. That's where they come from. Okay? Final two tabs, over here on the left, assumptions. We will make universal assumptions about changing the model for a company's forecast. One of the best practices that McKinsey talks about is you want to minimize the places in the model that you make assumptions. Because the problem is, 2 a.m. at night, bleary-eyed and tired, your model's all screwed up and you can't figure out why. Because when you've reused the spreadsheet, you put in some random assumption for a company that you forgot you changed, and then you're then trying to figure out, why is my current model not making any sense? Because it's got fragments from a previous model that you forgot about. So to mitigate that possibility, all the changes occur in 2 places in this model. 1 is in the assumptions tab. 2 is in the ratios tab. You'll also notice I'm using the color yellow arbitrarily. Pick whatever color you want. Yellow cells are cells that I can change. Non-yellow cells could screw up my model. I don't want to overwrite a formula. I don't want to overwrite a reference that's important. How do I distinguish? Yellow cells are not cells that I have to worry about changing. Those are the key to my forecast. That's what a yellow cell represents. Okay? We're starting with 3 assumptions. By the time we finish, there's probably going to be 20 more. Okay? Where we're really going to start is the final tab called ratios. We forecast the future because we forecast the ratios. It's a better way of forecasting. Okay, so we don't forecast numbers directly. We forecast the ratios, which get us the numbers. These are all of the income statement and balance sheet historical ratios as a percentage of sales, with the one exception being the revenue growth rate, which is a percentage change. But these are all percentages. Okay, and this is where we start. So what I'm about to do, you're going to do. Okay. So starting on the ratios tab, cell H1, I'm going to write the word forecast because I want to separate what is historical and what is forecast in my model. That is the income tab. Thank you. I'm going to do that anyways. On the ratios tab, try this again. Cell H1, write the word forecast. Cell H2, our first forecast year is 2023. I want to make this a relative year. So equals previous year plus 1. Because again, I don't want to hard code 2023 because if Parker Hannifin ever reports 2023, I want column H to be 2024. So equal previous year plus 1. Okay? Now as a placeholder for the revenue growth rate for 2023 equals the 2022 revenue growth rate. So H3 equals G3. And that is a cell which I'm going to make yellow, telling me that I could change this. Okay? Now, the reason I'm going to leave it equaling the previous year as a placeholder is just as we're building the same model, I want you to have the same information I do, so we're all going to have the same revenue growth rate. Don't type in 10.6% because that number's rounded. And if you type in 10.6%, you're not going to get the same answer I do. So equals the previous year. Yellow, because that's a number we can change. All right? Now, just to give you a sense of this, how it's going to work, I am going to go to the income tab. I am going to call H1 a forecast. I am going to take H2 equals previous year plus 1. And then I'm going to forecast 2023 revenue. So here's how we're going to do it. So for 2023 revenue in dollars equals 2022 revenue times left parentheses 1 plus from the ratios the revenue growth rate and parentheses. So if they grow another 10.6%, next year that would grow to 17,535.3 million. Okay? The ratio creates the forecast. Okay? Now I'm also going to take cells H3 going down to H27 and I'm going to format them to 1 decimal place, just to be consistent with the previous years. Okay, so 17, 535.3. Okay, now I don't want you to do this, but what if Parker Hannifin next year grew 7.5%? Type in 7.5, go to income, 17,051. The ratio creates the forecast. Now, the reason I don't want you to do this is because as we're building the model, everything is repeating last year. So we're going to leave it at 10.6, and the number on this tab for you should be 17,535.3. Are we with me so far? Great. So let's keep going. Back to ratios. The next ratio that we're going to forecast is EBITDA. These 3 kind of grayish items are critical to your forecast. So we're going to forecast EBITDA directly. So for H7 equals G7. 21.6%, and that's something I'm going to make yellow. Now, in the real world, if you work for JP Morgan, to get to EBITDA, you would forecast cost of goods sold, and you'd forecast the SG&A operating expenses as a percentage of sales. That would lead you to your EBITDA. Now, practically, our model doesn't care. Okay, our model cares more about the EBITDA, doesn't care about the intervening variables. So again, real world, I care about the intervening variables. I'm trying to make some shortcuts for you. EBITDA is what we're going to directly forecast in the model. So that's why I'm skipping the numbers above. Now, if there's anything I'm doing here that you're like, oh, I'd really like to do this, like feel free to add that to your model. Just make sure that cost of goods sold and SG&A lead to an EBITDA. They have to equal each other. Right? Now, next is depreciation and amortization as a percentage of sales. Again, equal the previous year, yellow. So H8 equals G8. Next line item is operating income, solve. EBITDA, operating income, depreciation, pick 2, solve for the third. I've picked EBITDA to forecast. I've picked depreciation to forecast. That will get me my EBIT or operating income. So for operating income equals H7 minus H8, 18%. Not yellow, because I'm solving for that. Now, if I want to be lazy, the formula for H9 is actually in G9, and I could copy and paste it over from G9 to H9. Next, tax rate. Tax rate is an assumption. So for H10, the tax rate equals, from the ratios, our 2023 ratios, our 2023 tax rate equals our 2022 tax rate, G10. So H10 equals G10. I'm going to make that yellow because, again, I could change that assumption. Tax rate in the future could be different than last year. But for now, placeholder equal last year. Everybody with me so far? Operating income after tax is no plat. So basically take my operating income times 1 minus the tax rate, get my no plat. Again, I'm going to be lazy. That is the formula in G11. Copy G11, go to H11, paste. 14.6%. I've solved for that, not yellow. The final income statement ratio is non-operating gains or losses as a percentage of sales. Equals the previous year. So H12 equals G12. Again, yellow, because that could change. So these are the key ratios for the income statement that we're going to forecast. I'm going to take column H, select the whole column that we just created. I'm going to copy column H. I'm going to go to select all the way through column M. I'm going to paste, and I now have forecasted ratios through 2028. I got 6 years of forecasted ratios, all repeating each other, equaling the previous year as a placeholder. Based on these ratios, we're going to go back to the income tab. We're going to turn them into dollars. On the income tab, the next ratio we forecasted was EBITDA in dollars. That's what we need. So in 2023, EBITDA in dollars equals, so this is H8, 2023 forecasted revenue H3, times, from the ratios tab, 2023 EBITDA as a percentage of revenue, that is H7 from the ratios tab. So that will give me 3779.8 million of EBITDA. Okay. The next line item is depreciation. Same concept. You're going to notice we repeat this a lot. Equals 2023 forecasted revenue, H3, times, from the ratios, H10, the tax rate. Oh, sorry, depreciation, wrong number. Equals H3 times depreciation, sorry, is H8, 632.1. Okay. If I subtract my EBITDA minus depreciation, I get my operating income. Equals H8 minus H9, operating income 3147.7. So very quickly, those ratios have created a forecasted operating income / EBIT for Parker Hannifin in 2023. Yes? For which one? So for EBITDA, it's just the revenue in 2023, H3, times the ratios, EBITDA as a percentage of sales, ratios H7. Okay? 23 forecast, percentage of sales, ratios. Yes?
Would you not highlight them yellow?
On this tab, nothing is yellow because it's all referenced based on the ratios. I'm changing the ratios, which will change these numbers. Okay? So again, don't do what I'm about to do, but notice if I change revenue to 5% and EBITDA to 20%, then the income stat is automatically adjusted. So that's what we're eventually going to get to in a few weeks after spring break. But for now, I don't want you to do that as a model, so I'm going to undo those two changes. And you should have, for the income tab, non-yellow, these numbers. Okay, but good question. All right, next, we're at operating income, we got to do interest expense. Here's the point. If you've read the book, which I'm sure many of you have not, you know that when we do an enterprise DCF, we use a constant capital structure. Okay? That's how you use a constant WACC. Okay? And so we also want to use what's called a target capital structure. So simplifying assumption is the current capital structure equals the target capital structure. So we generally leave the cap structure alone. It doesn't affect the valuation. Okay? Because free cash flow has nothing to do with debt or equity. Okay? It's operating values. So we don't really need an interest expense to forecast a valuation. However, we do like seeing the window dressing of clean statements that balance. So we are still going to forecast the debt and equity even though we're going to use a target capital structure. So the simplifying assumption is whatever debt or equity they have, we leave alone. Okay? Now again, if you ever want to change any assumption I give you, have at it. But I'm also telling you it will have zero impact on the valuation. Okay? But if you work at JP Morgan, they're going to make you do this. They're going to make you do the entire statement. Okay? So back to this. Interest expense as a placeholder equals the previous year. We're leaving the debt alone, therefore we're going to leave the interest that they pay alone. Okay? Interest income equals the previous year. Parker Hannifin doesn't have any, but if they did, they get the same interest income. FX gains or losses, 0. I don't know what's going to happen to the currencies, neither do you. So it's really hard to forecast gains and losses if I don't know what's going to happen to the currencies. So we're not. And again, they will not affect the valuation. Now again, if you know that a company is going to have big gains or losses because you think what's going to happen to the currency, you can always go here and change it. But I'm telling you, it won't affect the free cash flow valuation. Okay, so 0. Next, income or loss from affiliates equals the previous year. Whatever they are, they're going to stay. And finally, non-operating gains and losses equals 2023 revenue times, from the ratios tab, 2023 non-operating gains and losses as a percentage of revenue. So H12, 1080.9. So if we take operating income minus interest expense, minus plus interest income, minus FX, minus income or loss for affiliates, minus non-operating losses or gains, we get pre-tax income. You can look at the formulas over there on the left. Okay? Or if you want a shortcut, because I've already done that formula for 2022, take G16, copy it, go to H16, paste it, and you should get pre-tax income of 1811.5. Yes. Copy G16 to H16. Save yourself some time. Next, we have income tax expense. On the 1.8 billion of pre-tax income, how much do we have to pay in taxes? So, equals 1811.5, so equals 816, times, from the ratios tab, 2023 tax rate, H10. Ratio is H10. So they would pay 334.5 in taxes. Okay. Income before extraordinary items equals pre-tax income, 816 minus taxes, 817, 1477 of pre-tax income. Yes.
Can you show the formula again for net operating loss?
Gains or losses, because we had a ratio for that, H3 times ratio is H12. It's non-operating gains or losses is a percentage of sales times 23 revenue. All right, so coming down here to income before extraordinary items. The next item is called an extraordinary item. By definition, an extraordinary item should be extraordinary, non-recurring, doesn't happen again, came out of left field. So therefore, shouldn't happen again in 23, and because by definition they're extraordinary, we shouldn't be able to anticipate them, so therefore 0. Okay? So for extraordinary items, truly extraordinary items should be 0 in the future. Right? Now, if you know someone's going to have one, you can always put it in here, but generally, then it's not extraordinary. Yes?
Can you show the formula for
Income tax expense. It's pre-tax income, 816 times ratio is H10, which is your tax rate. So if I take, yes,
What would fall under extraordinary, like, loss?
I'm going to lay off 10% of my workforce and take a one-time charge.
Okay, so something.
Something like that. It's a one-time, non-recurring item. And I'm just telling you, if they knew about it, they'd probably take a reserve for it and it would be on their statements. If they had no idea it was coming or they didn't announce it, how do we know as an outsider so we don't forecast it? Okay? Yes? You think something's wrong? What's wrong?
That's the one for the I mean, the one on top.
Sorry, which one you want me to look at?
The 1,000,
The 1080.9?
no, the one about underneath of it.
I don't understand. Which way you want me to go? Down?
Down.
Down. Okay, pre-tax income. So I just took G16, copied over to H16. Because that had the right formula in it. Because I'm just following the pluses and minuses over here on the left. Okay. All right, so back to income before extraordinary items, minus the extraordinary loss, which is 0. That would give us our income before minority interest, so equals H18 minus H19, same number, 1477. Now we get to the minority dividend. Because we're leaving the cap structure alone, whatever dividends we pay, we keep paying. So the minority shareholders are going to get another $600,000 of dividends. So equals the previous year. Therefore, our total net income after those minority shareholders have been paid equals net income before minority interest minus the minority dividends, 1476.5. That's next year's net income for Parker. Okay. Now, the next line item down, because we're going to try and solve for change in retained earnings, is the preferred dividends. Same concept. If they had preferred dividends, which Parker does not, we would keep paying out the preferred dividends at the same rate. Okay, so equals previous year. Placeholder for another company that does have preferred dividends. Other adjustments to equity, 0. Same as the extraordinary items. These come from FASB when they change GAAP. Okay? So in the future, there's going to be a change to the accounting statements, which changes the income and the balance sheet because the accountants have to change the numbers. They generally have zero impact on cash flow, and we don't really know what some of the future FASB changes are going to be, so we generally don't forecast them. Zero. Again, if you know that there's going to be a FASB change, you want to put it in here, you're always welcome to do it, but I'm telling you, it's not going to really affect your valuation because it's a paper change. We don't care about paper changes. Okay? Zero. Net income to common shareholders, I want you to take cell G25, copy it, go to H25, paste it. 1476.5 net income to common shareholders. Common dividends paid, row 26, equals previous year. So H26 equals G26. We're going to leave the common dividends alone just because we're leaving, same thing, common and preferred alone. Okay? However, important point. To get to change in retained earnings, you can see the formula left, we take our net income, we subtract the dividends, whatever's left is what's going to get added to the retained earnings. But there's a problem. If I take 1476.5 and subtract a negative 569.9, that's going to have the equivalent double negative of adding the dividend, not subtracting the dividend. This is why it's very important to pay attention to your data source. I know, and you can see here, that Bloomberg reports dividends as a negative number, always. I know Bloomberg reports cost of goods sold, operating expenses, as a positive number. They're both outflows. On the income statement, outflows are positive numbers. On the cash flow statement, outflows are negative number. For whatever reason, it's what Bloomberg does. So that's the point of my data source. Even though I want net income available to common shareholders minus the dividends paid, because I know it's going to always come in as a negative number, the formula for H27 equals H25 plus the negative number that I know that's going to be in H26, 906.6. Does everyone understand that? By the way, they also do this with preferred dividends. Preferred dividends come as a negative number. Now, Parker Hannifin doesn't have any, but if they did, it would look just like the common dividend. It would be negative. The reason I told you to copy G25 to H25 is because I've already accounted for that in the model. So the formula should be H22 minus H23 minus H24. But because I know H23 is coming as a negative number, it's H22 plus the negative in H23 minus H24. Final step, take column H, complete income statement, copy it, go to column M, select it, paste it. We now have forecasted income statements going through 2028 in dollars. And again, something you would have appreciated on your midterm exam, go to the TII tab. Take column G, copy it, go to column M, paste it. You now have forecasted balancing TIIs through 2028. The only difference is these are now forecast, they're not historical data. So starting with H1, change history to forecast. So I'll be lazy. Steal the word forecast over here because I don't like to type. H1 through M1 forecast. Yes? When you go to the TII, take column G, copy column G. After you copied the whole column, go to column M, select, paste. It'll paste out the other 6 years. Okay? Then for the fun one, go to your CFI. Take column G, which is 2022 CFI, copy it, go to column M, paste it. You now have forecasted and balancing CFIs going through 2028 for Parker Hannifin. Again, 23 through 28 are now forecast. So I'll change the word forecast or historical to forecast on my CFI. And that's just to help me differentiate later, so I know what's what. So very quickly, we have created forecasts for the income statement, which created the income statement ratios, which then created the actual income statement dollars. That created the TII, and eventually half of the CFI. Okay? Now the other half of the CFI that is missing is the balance sheet changes. So we're going to now forecast the balance sheet. That'll give us TFI and the other half of the CFI. Okay, everybody with me so far? All right, so now we're going to go back to the ratios, and we're going to start forecasting these balance sheet ratios. Again, every one of these ratios is a percentage of sales as a placeholder equaling the previous year. The first balance sheet ratio, row 14, is accounts and notes receivable. So if our H14 equals G14, and we're going to make that yellow, because that's something that could eventually change. Then I'm going to take cell H14, I'm going to copy it. I'm going to select from H14 down to M23, and I'm going to paste. So that just takes the equals previous year and repeats that throughout that whole range. So just whatever the last year was, it just repeats. Okay? Now I don't want to do this for row 24. Okay? I think I accidentally did row 24. Don't do it for row 24. Okay? The reason why is for row 24, I want to take the formula that's in G24, copy it, and paste it from H24 to M24. Right now it's going to be 0. And so the reason why is row 24 is invested capital divided by sales. That's the productivity ratio off the ROIC tree. Okay? So this is a forecasted invested capital to sales over here. This is the historical. So these numbers come from the ROIC tree here. Okay? Now, when we forecast a company's balance sheet, I'll use Parker Hannifin as a good example. Historically, Parker Hannifin is spending about $1.20 to $1.30 of invested capital to generate $1 of sales. I don't want my ratios to be forecasted so that they're only spending 30 cents of invested capital per dollar of sales, because that would be a completely unrealistic balance sheet. Okay? So I've put into the model a little bit of a sanity check. All those balance sheet ratios create the invested capital to sales. So I basically calculated invested capital to sales down here, so I can basically see if my percentages are a little out of whack. Because most companies tend to maintain their productivity over time. Okay? So, continuing on. Now that we have the ratios, we will go to the balance sheet and continue creating the 2023 balance sheet. Okay? H1 is the first year of our forecast. H2, previous year plus 1. Now I forecast these 11 ratios, starting with accounts and notes receivable as a percentage of sales. Okay? So this process that we're about to do, we're going to repeat essentially 11 times. First one is accounts and notes receivable as a percentage of sales for 2023, 18.2%. So here's how we create the balance sheet item in dollars. Accounts and notes receivable in the balance sheet tab is row 6, column H, equals, from the ratios tab, H14, that's really weird, H14 times, from the income tab, H3. And for some reason, my ratio didn't get copied. So equals previous year. There we go. Must have hit backspace by mistake. So 18.2% should be the number in cell H14. times 2023 revenue should get you on the balance sheet 3189.3. Okay. Again, from a formatting standpoint, I'm going to take from cell H4 down to H33. I'm going to format this to one decimal place just to be consistent. So 3189.3. Everybody with me so far? Yes.
What did you multiply it by again? H3 from what tab?
So H3 for the income tab times ratios H14 from the balance sheet ratios tab. Okay. The next item down is unbilled revenue. So for unbilled revenue, H7 equals from the ratios tab, unbilled revenue is a percentage of sales, which for Parker is 0 in 2023. Again, for another company, it might not be 0. Okay, so H15 for ratios times from the income tab, 2023 revenue, which is H3. The next item down is inventory in dollars. Equals from the ratios tab, inventory is a percentage of sales, that is H16, all the ratios, times income, 2023 revenue forecast, H3. So that should get you 2448.2 in inventory. For other current assets, equals from the ratios, other current assets is row 17, so H17 times income, H3, gives me 7,057.1 million of other current assets. Next, long-term investments equals for the ratios tab. Long-term investments in 2023 was 0 times income H3. Next, we have other long-term assets, which is row 14 on the balance sheet, equals ratios H just make sure I'm doing the right one. Long-term investments H18 times income H3. Sorry, those long-term assets. I skipped over fixed assets. Let's go back. After long-term investments, which were 0, and I put in the wrong row, so that should be here. I then want to do net fixed assets. Okay, so that's row 12. So net fixed assets equals ratios H19 times income H3. There we go. Then I do other long-term assets equals ratios H20 times income H3. Okay. For some reason, that wasn't formatting correctly, so we put this back to one decimal place. Okay. All right, the next one after other long-term assets is accounts payable equals ratios. Accounts payable is a percentage of sales, which is row 21, so H21 times 23 revenue, which is income H3. The next one is other short-term liabilities equals from the ratios H22 times income H3. Other long-term liabilities equals ratios H23 times income H3. All right, So very quickly, if I've done this right, and I put in the right rows, lots of cells here, so just be careful when you're copying and pasting. These are the key items based on the ratios that we have forecasted for the balance sheet. Okay? But we still need to finish the entire balance sheet and get it to balance. And we cannot have a circular reference when we do so. A circular reference is an invalid model. In this class, we won't even grade them. Okay, so don't try and turn in a circular reference model. You should never have one in the real world. There's no reason to have a circular reference. Okay, because it's an invalid model. It's broken by definition. So I'm going to show you how to create the auto-generated balance sheet without a circular reference. Okay, and that's what we're about to do. In order to do that, we're going to forecast the liabilities and equity side of the balance sheet first. Okay, so starting out with equity, we're going to start out with preferred equity, which is row 28. Again, for H28 equals G28, because we're leaving the equity alone, not changing cap structure. So any preferred equity stays outstanding. Minority interest equals the previous year. If they had minority interest in the past on the balance sheet, we leave that alone. We don't pay it off, we don't increase it. Equals the previous year. Share capital and paid-in capital, that's APIC, equals the previous year. We're not issuing stock, so we're leaving that alone. We're not buying back stock. That's why there's no treasury on here. Okay, we're leaving the stock alone. The one we're solving for is retained earnings. We know that if we take last year's retained earnings, plus the change in retained earnings from the income statement, income minus dividends, that should be the ending retained earnings of the firm. So here's how we're going to solve for retained earnings in 2023. So for H31 equals last year's retained earnings, so G31, plus from the income tab, column H is 2023, change in retained earnings is row 27, so plus H27 off the income tab. So if our retained earnings go up by 906.6, they should end at 933.6.8. Okay, if our forecast comes true. Okay. Now I could sum the four above, and the four above should get me my equity value of 9766.5. I'm now ready to finish off the liabilities. Okay, so I go to short-term borrowings, H20 equals G20. I'm leaving the short-term debt alone because we're not changing the capital structure, equals previous year's debt. I can now sum my current liabilities, equals the sum of the three above. So basically, accounts payable, short-term borrowings, and other short-term liabilities. When I add the three together, I get total current liabilities of 6291.8. I then go to my long-term debt, which is long-term borrowings, equals last year's long-term debt, because again, we're not changing the cap structure. And pension liabilities equal the previous year, because we're not changing the cap structure. We don't pay off the pension that we owe. We don't add to the pension that we owe. Okay? So if I sum those three, long-term borrowing, short-term, other long-term liabilities, and pension liabilities, those three are my long-term liabilities. $11,301.6. If I take my current liabilities and add that to my long-term liabilities, I get my total liabilities, 17,593.4. And finally, for total liabilities and equity, equals total liabilities, G20 or H27, plus total equity, H32, total liabilities and equity, 27,359.9. Now, it's very important that my balance sheet balance. I need my assets to add up to this amount. So I'm going to show you the trick. Go to H16 equals H33. It'll make your balance sheet balance every single time without fail. Just make your assets equal to liabilities and equity. Ha ha ha, right? Which means that we're gonna need a plug in the assets so that when we add up all the assets, it will equal that amount. Okay? The plug, or what we're gonna solve for, is excess cash. Excess cash is the plug in our model. It's what will make all the balance sheet balance. Okay? So we're forcing the balance sheet to balance, and we're gonna plug it with excess cash to make sure it balances. Yes?
Could you go over to, could you do, could you do total liabilities?
Total liabilities are current plus long-term. So H22 plus H26. And then liabilities and equity is total liabilities plus total equity. So it's a lot of sums. Okay? Now, back to the assets. Since I'm going to plug or solve for excess cash, the other two items that I need to make sure because I got all the other assets, is I need operating cash and I need goodwill. Okay? So let's talk about operating cash in 2023. That's cell H4. On the assumptions tab, you'll see an operating cash as a percentage of revenue here, 2%. You'll notice it's not in the ratios tab. Here's how I'm delineating, okay? If something changes year by year, ratio. If something stays constant across the years, assumption. That's how I've set up the two tabs, okay? Generally, if a company needs a minimum amount of cash to survive, it's probably not gonna change, okay? That's why it's on the assumptions, just letting you know, okay? So the point is, 2% of sales, which is 1 week of cash, is the minimum amount of cash I'm saying that they need. So 2% is the starting point. We can always change that. So here's the point. Go back to our balance sheet for operating cash in 2023 equals, from the assumptions tab, B3, times, from the income tab, 2023 sales, which is H3, 350.7. That's how much cash they need to run their business, minimum. Okay? Now I'm going to copy this cell across the years, and because there is only one assumption for operating cash, I'm going to edit that cell, and I'm going to put a $sign in front of the B and a $sign in front of the 3. And what that's going to tell Excel is every time I copy it and paste it, to always refer to cell B3. Make it an absolute reference, not a relative reference. So $sign B, $sign 3 in the formula. Okay? And then the final one is goodwill. I don't know who Parker Hannifin's going to buy, and I don't know how much I'm going to pay for them, so I'm going to leave the goodwill alone. Okay? Can't forecast acquisitions in the future. So we're not. Even if we did, most acquisitions are pretty close to NPV 0, so they're not going to probably change the value too much. Now, I also know that goodwill is only impaired. And if it's ever impaired, it will be written down but have 0 impact on cash and 0 impact on taxes. So impairing the goodwill doesn't matter. So we're just going to kind of leave the goodwill alone and let the accountants fight it out because it doesn't really matter to the valuation. So equal the previous year, question mark.
You just copied in the total long-term assets row instead of the goodwill row.
I copied the wrong one? Okay, thank you for,
It's supposed to be 2 rows above what you did.
all right, so undo. Thank you for pointing that out. I'm doing this a lot today. All's running together. Equal the previous year for goodwill. Okay, everybody with me on that? Almost done. So now we are ready to plug for excess cash. So here's how we plug for excess cash. H5 equals total assets, which is 816, minus all the other assets. Minus operating cash, H4. Minus accounts receivable, H6. Minus unbilled revenue, H7. Minus inventory, H8. Minus other current assets, H9. Minus long-term investments, H11. Minus net fixed assets, H12. Minus goodwill, H13. Minus other long-term assets, H14. Hit enter, 98.5 of excess cash, no circular reference. Okay? Now I can just put in my sums. Take my current assets, which is H10, sum everything above. Equals sum from H4 all the way down to H9. Take my long-term assets. Sum the four above from long-term investments, net fixed assets, goodwill, and other long-term assets. So 11 through 14, H11 through 14. Long-term assets, 14,216.1. If I want to do a check, equals current assets plus long-term assets, that should be the same number as my liabilities and equity when I sum it up. Okay, final step, delete that. Take column H, copy it, go to column M. We now have forecast through 2028 for Parker Hannifin's actual balance sheet. Go to the TFI tab. Take column G, copy it, go to column M as in Mary, and paste it. We now have forecasted TFIs going through 2028. Take the word forecast, make sure that starting in 2023 on TFI, you switch history to forecast. And carry that forward through 2028. CFI, we've already copied, so we now have balancing CFIs with the balance sheet in here. And there's an error down there. I'll figure out what I did. So let me take column G, make sure column M. There we go. Remnant of the previous copy. Just copy and paste G through M for the CFI. Didn't like what we did in the balance sheet before. And again, make that a forecast. Copy that all the way through 2028, column M. Final step, and unfortunately, here's where I did make a mistake when I posted this morning. Go to the EP. You'll notice for whatever bizarre reason, it goes to column G and then column N, because H through M are hidden. So select column G, select column N, right-click, unhide. And these are just scraps from a previous model that I forgot to get rid of. So we're going to overwrite them, or you can delete them and overwrite them. But basically take column G, copy it, go to column M that's now been unhidden, paste it, and then you have economic profits that balance through 2028. And again, add the word forecast back. For 2023 to 2028. If you have gotten to this point, and one way to check your math is on your CFI in the out years, it should be 778.6. This is the next homework assignment. This is all you have to do is to get to this point for the Monday after spring break. Later today, I'm going to adjust the next homework assignment to basically say, upload this file. If you do, you're done. You don't have any more homework before you get back the week after spring break. And we're going to start exactly with this file and keep building. I am not going to post a solution. So it is your responsibility to get to this point individually. There's no sharing of files. You got to build it yourself. Okay? Now that's the other point. If you've done with this, after you do your presentations on Wednesday, have a happy spring break. Don't think about this class till you come back. Okay? So please take advantage of that. Submit this file sometime this week. If you couldn't get here in class, this has been recorded and will be posted on YouTube a little bit later today. Yes? I'm sorry? This is homework 8. I'm going to change it. This is now homework 8. I got to change it, and then you can submit. Wait till I change it, and you'll see an announcement. All right? Again, I'll post this file a little bit later today. Good luck.